Hi and welcome to this think tank. I'm Michael Yardney and my co-host for this session is Ken Race, Director of Metropole Wealth Advisory. Hello, Ken.
Hello, Michael.
Now, we started these regular think tanks last year and we're planning to do these on a regular basis this year because the world of property, economics and finance is changing. So I know last year, thousands and thousands of people watched them. In fact, I saw the statistics. Most watched them right till the end because we're trying to make these full of information. So rather than making them at a particular time that you've got to come and lock in when it suits us, these are available for you without having to register, without having to leave your name, but they are full of information. So please pay attention. And I guess my advice to you would be don't multitask, turn off your other programs. We've got lots of information for you. And at the end today, we've got a special segment about our thoughts of what's happening to the property market. But in particular today, we're going to talk about the scary headlines that are out there at the moment because a lot of people seem to be worrying we're going to go into recession. So at the end of this discussion, you're going to understand what a recession is it likely, what can you do to protect yourself, and what you should do. I guess the reason people are worried about a recession is because of the headlines in the media. There's a crisis of confidence. And currently, many commentators are worried that consumer confidence, which is dropping, negative effect of house prices falling, the negative wealth effect where people aren't feeling as wealthy, a cut to consumer spending because they're a bit nervous, a collapse in the construction industry, which is one of our biggest employers, and all the overseas headwinds that are occurring could combine together and create a perfect storm leading Australia into recession. And the problem is sentiment matters. It's just one of the realities of the property market. So sometimes the mood, how we feel, is just as important as the fundamentals, because you're going to find out today that the fundamentals are pretty good. But a lot of people are looking out, wondering about what a recession is. And Ken, a lot of people who are watching this have never been through a recession because we haven't had one for a long time. So can we maybe start off with a bit of an understanding of when was the last recession and what does a recession mean?
Yeah, well, it was the recession we had to have under Paul Keating, of course, when interest rates were going through the roof and he was trying to slow down the economy. So it's certainly been since those days. But a recession, if you look at it in its definition, it's when an economy slows to a point where its growth is less than the previous period. So what the statistics show is they gather the prices on everything, property, mortgages, going on holidays, medical, petrol, energy. And if those prices go down because of less demand, then we're going into negative growth. And if you have two successive quarters of negative growth, that's what's called the recession. So like anything, how bad or how severe is that recession has to be the quick second question.
Well, the fact is Australia is going to have a recession one day, but not anytime soon. Now, you don't have to believe me because in his first public speech a week or two ago, Reserve Bank Governor Philip Lowe highlighted the issues that are likely to shape our future. Now, I think the people who run this country think he's a pretty cluey guy because they pay him a pretty penny to look after the Australian economy. And Governor Lowe said that we're not going to fall into a recession. We're not going to fall into a recession anytime soon. He thinks economic growth is going to slow a little bit in the next little while. And he thinks the housing market that's dropping a bit is going to be a drag on economic growth. But he also believes that there's lots of good things in the future. And that's what I'd like to spend the first little bit talking about, explaining to you. So this masterclass should probably last about 30 minutes or so. We're going to give 6 reasons why we're not going to recession from Governor Lowe. Then I'm going to give you some of Ken and my thoughts. We're going to discuss why we also think we're not going to go to recession. And then we're going to talk a little bit about our housing markets, because the housing markets don't work in isolation. Similarly, the Australian economy doesn't work in isolation. So Governor Lowe told us that various political issues and trade wars are creating some downside risk in the world economy, but the economy of our trading partners, and in fact the general world economy, is going to do pretty well over the next couple of years, Ken.
That's right. And, you know, when you take into account Southeast Asia, particularly China, India's growth rates are moving up. Certainly Europe is having a few falters. The US is on the improve. So when you add all those together, the world economy is certainly on the upward trend. And more particularly, the countries that we trade with are on the upward trend.
On that basis, then, the Australian economy is also forecast to do reasonably well. So you can see the RBA's forecast in the graph here. And what they're suggesting is that we're probably going to have 3% growth of our GDP next year and 2.75% the year after. So yes, the economy is slowing, but it's still above average growth, Ken.
That's right. And we've also got to look at inflation, which we're going to talk about in a few minutes. But as long as that growth rate is over inflation, at least the economy is growing in real terms. So that's what we need to look at. And the impact then on jobs is then the crucial element that we need to focus on.
Well, sure. During a recession, people get nervous. Businesses don't employ. They don't carry much stock. They stop manufacturing. Jobs go. People get nervous. They don't buy things. So it's a bit of a downward spiral. But currently, we're creating more jobs. Last year, in 2018, 212,000 full-time jobs were created and 51,000 part-time jobs. So we are creating more jobs. And the other thing is that there are more full-time jobs, which are good. And then when you look at what the forecast for unemployment is, it's slowly falling. Ken, I remember, we're both old enough to remember when unemployment used to be around 10%. Now it's 5%. And it's forecast to drop a bit more.
Correct. So what we're learning now is that absolute rate is certainly an indication of the economy, but it's where is that unemployment rate falling? Is it geographically? Is it a particular part of the population? Is it a particular industry? Yeah, but overall, you know, at that 5%, it's doing pretty well on average. And then different geographic areas are doing even better than that.
Well, it is, because in New South Wales and Victoria, our two powerhouse economies, unemployment is down to about 4.25%. But when you actually look how property markets are working, those states with higher unemployment in general, like Western Australia, Darwin, where they've had challenges after the mining downturn, their unemployment is higher and their property markets are performing poorly too, because jobs growth leads to population growth, leads to people wanting to rent houses and then eventually buy houses. And job vacancies are at a record high, and unemployment is forecast, as you can see on this graph, to drop a bit further in the next little while. And the fact that that's happening is also a good sign, because it means finally there are some signs that wages growth is going to pick up. Now, Ken, you also mentioned inflation, and that's important.
Yeah, because inflation is the growth in the price of items that you have to pay for. So if prices are going up, 5%, 10%, then the economy is overheated, and then the government has to try and slow it down. So if we've got GDP growth at 3% and inflation at just over 2%, we're actually making real headway. And that's really what's important, because that means eventually the house prices will start to pick up. As goods and services prices pick up, then businesses will employ more people, the unemployment rate will go down, and then we'll start to see improving wage payments, which has really been the lag in the economy over the last handful of years.
You're right, Ken. Now, they were Philip Lowe's suggestions of why we're not going to fall into recession, but I'd like to add some others of my own and Ken's. And the federal budget's coming up not too long ahead now, and it's thought that it's going to deliver a surplus. And this is for the first time in years. If you and I in our households spend more than we earn, we actually go into a deficit and we've got to borrow. On the other hand, if we earn more than we spend, we end up having some cash in the bank. And that's what the government's going to do, Ken.
Correct. And it's really the stars aligning for the current government, because with this increased economic activity, there's been more people employed. That means they've collected more taxes. That means they've paid out less Centrelink payments. It also means that as companies have increased their profits, they've paid more tax. So the government's been able to reduce some of its costs, and they've received more money by way of taxes, not by taxing people more, but by actually increasing the size of the pie to collect more.
Okay. As we work through things, I want to go through some of the positive signs amongst all the pessimism in the media, because only again today I read about how we're going to have a recession, and a lot of these discussions are coming from overseas economists who don't really fully understand what's going on. So let's look at some of the good things that are happening. One of the good things that's happening is infrastructure spending, and a lot of it is happening from the state governments, Ken.
Correct. So we're seeing, particularly in the states of New South Wales and Victoria, unprecedented expenditure in roads, in rail, in energy, in water, and we're seeing significant expenditure in infrastructure in the other states as well. The beauty of it is they're not one-off projects. There's actually projects now in the pipeline that is going to last the decade and beyond. So that means that'll keep employment levels up, and infrastructure uses local wages, local employment labour, and also predominantly local raw materials. So we benefit from the expenditure, but then at the end, when the project's finished, productivity normally increases, so the costs to do business will go down. So we get an immediate hit and then a long-term hit as the benefits of that infrastructure come into play into the economy.
Now, another big plus for Australia's economy and for our property markets is that our population is growing. And sure, it's slowing down a little bit, but our population grew by 390,000 people, 1.6% over the last year that was recorded, according to the Australian Bureau of Statistics. And it came from two sources. It came from natural increase. We're having more people born than are dying off, and also overseas migration. And overseas migration contributed about 60% of our population growth. Now, I know recently Scott Morrison came out with the concept that maybe we'll slow down immigration a little bit, and maybe we're not going to force them to go to Sydney and Melbourne. Having said that, they're talking about cutting immigration by about 30,000 people. It's not in the scheme of things a lot. It's less than 10% of our total population growth each year. And to say, well, I'm going to move them and not let them go to Melbourne and Sydney, they've got to go where the jobs are. And so when we look at the next slide, you'll actually see where immigration has grown, or population growth has grown. So Melbourne or Victoria, but basically they're going to the capital city, Melbourne, and Canberra have had the most capital growth at 2.2% per annum over the last period finishing June last year. But if you look at Victoria, because just the bigger size of 2.2% population growth means lots more people that initially need to rent and then eventually will buy houses. Now,
just on that quick one, Michael, think of it as fuel into a car. The fuel into the economy is labour. It is population growth. And while a lot of people are saying, is it unsustainable at the current levels? If you go back through the 50s, 60s and 70s, the proportion of immigration to total population was actually higher then, when we had less infrastructure to look after these people.
Well, I've just come back from an extended holiday overseas in Europe, and our population density is nothing like what's happening there. And as long as we build the right infrastructure and get our town planning right, there's great opportunities. Now, another positive factor that we're both seeing to help the Australian economy, and again, we're talking about reasons why not to panic when there's all those headlines, because you've now got to, look, the media's headlines are there to get you the clicks, to get you through. You're not the client of the media. People think the media is looking after them. No, it's looking after the sponsors. So the more negative headlines they have, the more you go there. So we're giving you another view of things. And the Australian dollar is low and likely to remain low for some time, drop a bit further. And this is good for our export industries, for our balance of payment, and that's good for our economies.
Yeah, we're seeing the rates at the moment, call it in the low 70s. That's a bit higher than some people would have liked to see or estimated. And the reason that our dollar has stayed up above 70 is really because of our exports of iron ore, of coal. So the offset of that is the miners have made more money. That means they've paid more taxes and they've employed more people. And we've seen increases in both the volume and the price of these minerals, which for most of these mining companies, an extra dollar in the price goes almost all to the bottom line because their costs are basically fixed at that level. So it's sort of a balancing act, and we're certainly getting the benefit by finally moving the budget, I think, into surplus. And hopefully over the longer term, it will continue to be able to eat into debt.
Well, there's a number of industries, not just the mining industry, that's supporting our economy, and I see as green shoots that we should be looking forward to as opposed to worrying about the economy. One is agriculture, and if we get it right, we will be the food bowl of this huge population in Southeast Asia. The mining economy is doing very, very well, as you've already said, Ken, with increased turnover, but also increased prices for that turnover. Tourism. People are coming here, and we're very lucky that they're loving Australia as a tourism venue, and that's helping our industries. And also another export of sorts is our international student education. This is a huge export industry for us, and that went up about 17% last year. So there's lots of reasons not to be concerned. We're not belittling some of the challenges that are there, but I can't see a recession coming up. Now, what about our housing markets? Because in his recent talk, Governor Philip Lowe said that we are going to have continuing falling house prices, and I think we agree with that. Not everywhere. Remember, there's not just one property market. So clearly not all the news is good for our housing markets. But what I'd like to maybe do is talk about some of the positives that are there. Interest rates are low, and they're likely to fall further this year as the Reserve Bank tries to stimulate our market. The good news is the Reserve Bank's got plenty of ammunition to be able to do that because it can lower interest rates. And it is now even talking about that. So before it said the next move is up, they're not going to suddenly go from the next move is up to the next move is down because it means it's going to scare people. So they said, oh, look, there's a 50% chance. Ken, the big question, of course, is a bank's going to pass on any interest rate cuts.
Correct. And they may not. And also, we've got to look at, will the banks increase their rates even if the Reserve Bank reduces cash rates? So sure. There's the double whammy. But even if that happens, we're talking at the margins, because most people have got loans, can I say it, around the 4% mark, plus or minus a bit. So nobody's talking about interest rates going to 6 or 7%. They're talking maybe 25 basis points increase. So 2 of those is 0.5%. So
interestingly, I read an article this morning from an overseas economist saying Australia's going to go into recession. So, of course, clickbait, I looked at it, and it also said interest rates are going to go to 0. I don't think that's the case, but I do believe there'll be 2 interest rate cuts over this year, which may take our interest rates to 1%. Now, the banks take some of the money from locally and others of their funds overseas. So as Ken said, they may not be able to pass on all the interest rate cuts, but 65% of their funding is locally and will be affected by the Reserve Bank's official interest rate. But that won't be enough to buoy our housing markets. What is also going to be necessary, in my opinion, Ken, is to loosen the screws set by APRA, because their tighter lending restrictions are more an issue than the cost of money.
Correct. And I think even though some of those restrictions have been lifted, I think the magnifying glass, the microscope has been on the banks. So they've pulled the pendulum way over the conservative side when looking at people's capacity to repay debt. What is your actual living costs? What is your income? So I think that restriction in loans in credit has been exacerbated by that. But at the end of the day, banks need to make money. They need to give their shareholders a return. They need to still be able to maintain their employment levels. So I think over time, those restrictions, some of which are internal, will also be relaxed.
Sure. So when we look at the property markets, the good news, as I started to say, is interest rates can and are likely to drop to help underpin them. Residential vacancy rates are tightening because rental growth hasn't been high for a while, but it's starting to pick up now. There is an underlying demand for property. It's still strong, but it is being hindered by consumer confidence and also tight credit. But the year has started off better. The auction clearance rates are picking up better than they finished off last year. And the team on the ground from Metropole in Sydney, Melbourne and Brisbane are noticing more people are open for inspections, more interest, more people keen. And interestingly, our inquiries from new clients have doubled than what they were at the end of last year. And I think a bit of it is people are wanting to get in a level of uncertainty with what's going to happen after the election, what's going to happen to capital gains tax, what's going to happen to negative gearing. So if you're in the position, I wouldn't be buying properties just because you're scared, but if you are in the financial position and it fits in with your long-term strategy, it definitely is worth considering getting into the market now, because underlying demand, as I said, is going to pick up between now and when the election occurs. And there is an oversupply of property, so you've got to be really careful about which properties you buy. But the oversupply of new apartments in many locations is going to start to come down now because the pipeline of new construction is starting to dry up. But the big unknown at the moment is consumer confidence. And see, it's clearly a mixed bag of economic fundamentals. I've told you some good ones and there's lots of bad ones as well. And these are all going to interplay on our economy, on our housing markets and our confidence. So while the fundamentals are easy to quantify, the big unknown is, will consumer sentiment that is currently low changed for the positive or for the negative, and it may not change much till the next election. This is the latest Roy Morgan ANZ Consumer Confidence Index, and you can see how it's jumping around a lot, it is dropping at the moment. You can see the various factors that have made it go up and down, but it's still above average. And so people are starting the year reasonably confident. But those who take a long-term view, if you look at those blips, Ken, when people in 2016, 17 were uncomfortable, when they're uncomfortable in 2012, or when we go back even further, 2008, anyone who made a decision to buy a property then and go counter-cyclically did very well. I remember 3 days ago, I had a chat with Sean, a client who came to Metropole in 2008 in Sydney, just after during the global financial crisis. We bought Sean's first investment property for less than $300,000, $285,000, a two-bedroom apartment in Marrickville. He bought two further ones 10 years down the track. He bought it at a time when there was all the talk about a recession overseas and it was possibly coming here. He bought it at a time when people were worried about the economy. He took a long-term view and his properties have doubled and almost doubled again. So my suggestion is, if you're a long-term player, don't allow the last 30 minutes worth of news to affect your 30-year plans, because these downturns you're seeing at the moment of confidence, but it would actually relate similar graphs to share prices, to property prices, to the economic cycles. The ups and downs are temporary, but the long-term trend of property value growth is permanent. But interestingly, currently, the time to buy a house index, which is part of the big consumer confidence, is on the low side. In my opinion, Ken, a great time to buy countercyclically.
Correct, because I think, it's still showing that people are more positive than they are negative.
Oh, yes.
The index is over 100. It's really caution that's really retarding people, plus due to those issues that you mentioned, such as interest rates, wage growth, etc. So I think people are ready to move. They just don't have the confidence to move. And some of that can be dissipated by getting some knowledge, understanding more, talking to the right people to actually understand what it really is like out there, as opposed to those headlines that you see in the newspaper or the radio.
Well, I think that's partly the reason, one of the reasons we're doing this particular think tank, and we're going to be doing them more regularly to give what we hope is a balanced view. Some people would say we're optimistic rather than pessimistic, but I hope that we're being realistic because we've done it, we've been through it, we've lived through it, and we're giving reports from people like the Reserve Bank who pretty well know what's going on. But I think the answer is you can't just buy any property. This graphic shows you our view that 80% of the value of your properties or the performance of your property is going to be related to the location of the property, and a segment of it, maybe 20% of its growth, is going to be related to the property itself. So we use our top-down approach to find the right locations, and there are still locations where property values are going to grow, but I'm suggesting you look at long-term growth. Now, we're going to go into this in more detail in our podcasts, in our blogs, in our webinars, so it's not the right time to go into it now, but I'm just suggesting if you're going to buy a property, be really, really careful, because not all properties are going to perform strongly in the next little while. But we are going to give you good details about which are going to perform better than others and what to do and what you can do to prevent your risks at our upcoming property market and economic updates in Sydney, Brisbane and Melbourne. So go to propertymarketupdate.com.au where you're going to see Ken, me, Dr. Andrew Wilson, and local property experts talk about what's happening in the property markets. But just to go into the property market a bit more, I think it's important to look more at long-term trends than headlines at the moment, because it's too easy to get sidetracked by the headlines. So have a look at how your state is, where it is, and if you're not in the sort of state where there's going to be in the medium-term good growth, then don't invest there. Become a borderless investor. But don't just look for what's working now, the next hotspot. I mean, surprised now how some of the, what I thought were more experienced, better property commentators are chasing hotspots and what works now. We have always gone for what's always worked. Also have a look at how deep the market is, because you need an area that's going to have current and future levels of multiple growth drivers and population growth and economic growth. And so, sure, there are some short-term regional growth areas that are going to do well. Look, Hobart was an example of it, but Hobart had 5,000 transactions last year. So when I say how deep is the market, it's so easy to swing that to the upside, but also to the downside. So have a look at what the long-term fundamental drivers are. Have a look at what the current and future levels of supply and demand are. So to get capital growth, you need demand, but you also need people who can afford to and are prepared to be able to pay for higher property values. So what I guess I'm suggesting is there are some areas that are going to underperform, because in the next decade, blue-collar areas, working-class areas are not going to have as much wages growth as areas where there's more knowledge workers and people in the finance industry and who get commissions. See, a lot of trades are going to have difficulty having higher wages because there's going to be a lot of offshoring of manufacturing and production, and there's going to be artificial intelligence coming in. So we actually have to go and look for areas that are going to outperform the averages, because the people there's wages are going to go up above average. And that's really going to be the three big capital cities of Australia, and then certain suburbs within there. And the census tells you that there are some suburbs where wages have gone up 50% more than the state average. And they're the ones we target. And because they're the sort of people that are going to be prepared to either pay more to rent or pay more to buy in those areas. And then you've got to buy the right sort of property in those areas. But Ken, the other big factor is we are going to have ups and downs. So we're going to have to actually mitigate our risks. And how are we going to do that?
I think people need to sit down and formulate where they are now and where they're going to go to, where they're trying to move to, and put in place that plan that actually looks at all the individual areas that could create risk and then mitigate that. So there's things like, what structure did I buy in? What's the tax implications? What happens if I injure myself or I get sick and can't work? How do I manage interest rate volatility? What happens if the market doesn't quite grow at the rate I wanted? Did I buy a property where I could add value to actually come outside of the market? So what you need is a holistic view at first, looking at all those individual components that effectively become the foundations or the infrastructure to then build that wealth portfolio on. And
well, that's what we specialise at Metropole. So on the one hand, I really would like you to go to propertymarketupdate.com.au and register and join us for our one-day events in Sydney, Brisbane and Melbourne. We're going to hear this in a lot more detail. But that's going to educate you. But I propose that you go to metropole.com.au and organise a time to have a chat with Ken about wealth, financial planning, wealth advisory, structuring, or our property strategists, and they work hand in hand. And that's the beauty, because property, without looking at the rest of, it doesn't help you grow, pass on and protect your wealth. And that's what we try to do. So just growing it without protecting it and having it in the right asset structures to pass on doesn't work either. So what we do is sit down and draw up a plan, whether it's a property plan, if it's pure property, or if it's wealth advisory, a wealth plan, and then you're going to know. So what we do is we bring your future forward to today to plan for your future, so that it's not just talking about property, it's talking about the future and where you want to head. So Ken, quick summary, what area do you specialise in when you give advice?
Yeah, it seems to be quite common, because most people have the same issues or have made the same mistakes. So I make sure that the buying entity is correct. Did they buy in the right name, the right structure? A lot of clients, their tax is wrong. I saw a client the other day, and the structure they had, they were paying a lot of land tax, but there was a way to actually reduce that quite considerably with full approval by the government. So their particular accountant and tax specialist didn't understand those issues around property, and they were well and truly overpaying a number of taxes. So we look at that. Estate planning. I had a client the other day who was really worried about how to pass on the assets to their children, because they know that one of the children is actually married to somebody who's a bit of a gold digger. So how to protect that? How to make sure it stays in the family? We have a lot of clients who are trying to uplift and leverage their super to buy property. But you've got to do that very correctly, very specific, and in a sequence. And it's one of the few things that if you do wrong, it's disastrous. So we look at all that. We look at asset protection. If you've bought assets in the wrong name, and particularly in individual names, and you're now exposed to potential litigation, how do you protect those assets without triggering all those taxes? And another area that's really coming up more and more common is people coming who want to do a small development. So how do you do that? How do you structure it correctly? How do you mitigate the risk? And then we put that plan together, but that's where the fun starts, because from there on, we give you hand-holding to implement that via prioritizing each of those tasks. And it's that hand-holding that, can I say, forces people to get a result, that forces them to do it when life would have normally got in the way.
Fantastic. So if you want to find out more about how we can help you specifically, go to metropole.com.au, click on one of the links. We'll get back to you. Have initially an obligation-free chat so you can see what's going on. Also look forward to catching up with you at our one-day trainings. I think it's still great to be able to see people face-to-face live and ask questions. Look forward to it. And I look forward to catching up with you again really shortly on one of our regular think tanks. Thank you so much for spending your time, investing your time, educating yourself and helping yourself. Now, if you've got benefit from this and you think it's been worthwhile and you know somebody else who you think would get benefit from this, tell them about it. Tell them to come to Property Update. They don't have to register. They don't have to leave their names. We're trying to make it as easy as possible to educate as many people as possible because there is so much, in Donald Trump's words, fake news around. Thank you so much for your time, Ken.
Thank you, Michael.